Okay, let's get started. Good evening, everyone, and thank you for carving out some time to join us this evening on our insurance recovery Q&A session. We believe education is the key to successful recovery. The more you know now, the better off you'll be on the back end of the claims process. I just want to introduce myself. My name is Rino Benenati. I'm one of the vice presidents of the Greenspan Company, Adjusters International. I have been a public adjuster, public advocate for about 31 years now, and I've been involved in pretty much every firestorm in recent history on the West Coast, including Canada. Greenspan itself is the oldest and most respected public adjusting firm in the country. We've been in the LA area for 79 years now. We have a huge footprint. And these webinars are our way of giving back to the community who supported us for so long over the years. And we strongly believe that the information that you garner this evening will help you in the weeks and months ahead. Before we begin, we want to acknowledge the incredible devastation that's occurred and the emotional burden and toll it has taken on everyone involved. It does not go unnoticed. Our hearts go out to every individual that's going through this. Unfortunately, in our industry, we see it all too often, and we just wanted to acknowledge the pain and the trauma that this has caused. And we're hopeful that with these webinars and with the information that we're able to share with you, it will help ease some burden of the confusion and how to navigate these complex issues. You're suddenly thrust into the world of insurance, and the insurance companies, unfortunately, don't educate you on how to maximize your recovery. With that said, let's begin. I want to start with, we're going to go through some slides, and we're going to cover a lot of information, maybe take some screenshots if it makes sense. We're going to start with some common misconceptions. The first one is, I have a policy and I've paid my premiums. My policy limit states I have X. This is what the insurance company will pay me, right? Well, in a perfect world, that would be great. Then my industry wouldn't exist, and there would be no need for advocacy. The reality is that you have to prove what you're owed to the insurance company. You are now a claimant. And as a claimant, the burden of proof is on your shoulders, not the insurance company. They have the money and they have to pay you, but certainly without making of a proper claim, a defendable claim, you're going to be at a disadvantage. So simply having a policy and paying the premium does not guarantee that you're going to receive the full policy limits without justification. Now, the caveat to that is if you're so grossly underinsured that they come out and pay the policy limit, that's a whole nother conversation. But typically, again, you have to provide a claim, and the measurement of the claim has to be accurate in an effort to fully recover financially based on how that policy responds and what the limits are. Misconception 2, my insurance is being really cooperative and they have put me in a temporary residence. Well, that's their obligation. The insurance company is legally obligated to provide these advances and accommodations as per your policy contract. We refer to the policy as a contract because it is. You've bought in this contract hoping you never need it, and now you do, and you're subject to the conditions, definitions, forms, and endorsements that are in that contract. So you have obligations to meet, and the insurance carrier who wrote the contract has obligations to meet. So operating within the four corners of that contract is critical, and understanding how it responds to your specific situation is one of the most important things. And that's why we do these webinars, again, to share and help you navigate what that all looks like. So, thank you. The next slide is a summary of coverages. We're going to jump right in. The way the anatomy, if you would, of a contract, again, I'm referring it to as a contract. I might say policy, but they're interchangeable. It breaks down into four categories, and most carriers have these four breakdowns. It's listed as A, B, C, and D in your policy. The first one is dwelling, of course, and that's the big one. That's the house, the structure, the main primary dwelling where you live. B is listed as other structures. And before I get into B, I want to have you look at that green bubble dot. Now, in that green bubble dot, under A, there are sub coverages or subcategories, if you will, of coverages. And those would be considered extended replacement cost endorsements that kick up the limit of A. And I'll get into that in the next slide. Also under A is the code upgrade. You have to bring the building up to code when you rebuild or repair. Also under A is the debris removal and landscaping. So those four additional categories are under the coverage A. And it's very important that you understand that, because you're going to be tapping into all of those for coverages, as well as the basic primary coverage or your stated limit or your base limit of coverage A. B, the yellow bubble dot, other structures. That's driveways, walkways, separate garages, things that are detached from your main dwelling. That would be considered other structures: pools, retaining walls, exterior sprinklers, workshops, sheds, things of that nature. And again, they have to be detached physically from the main structure to fall under the category of other structures. Now, that yellow bubble dot you see under other structures also has some subcategories, and you may have extended replacement cost endorsement under that. Obviously, if you rebuild the garage, the workshop, the fences, what have you, retaining walls, those have to be brought up to code as well. And so that's part of coverage B. And of course, debris removal as well. The debris field is not just the dwelling. It's also the other structures. It's the personal property. It's the dwelling. And that's why they have a debris removal coverage under other structures as well. C is personal property, and that's the contents of your home. The way you kind of look at that is, if we were to, before the fire, if we peeled off the roof of your home and we tipped the home upside down and shook it, whatever falls out would be considered your personal property. That's the furniture, the appliances, like, toaster ovens, microwaves and such, clothing, jewelry, firearms, things like that, things that are going to fall out, the loose items that we all have in our homes to make our lives comfortable. And under that, you have scheduled, and under the dark blue bubble dot, you'll see scheduled items. These are, again, subcategories under that coverage. You may have an extended replacement cost endorsement as well. And also the debris removal is part of that coverage as well. And so lastly, we have coverage D, which is loss of use. Additional living expense or fair rental value. This is when the home is uninhabitable, either due to smoke damage or any kind of damage that renders the house unlivable. The insurance policy pays in a separate bucket of coverage for you to stay elsewhere. And that's for your housing. They rent you furniture, animal boarding's covered, boat storage, and extra mileage. And we'll get into all these separate A, B, C, and D categories in detail in these slides that are coming forth. So we're going to go right into coverage A, dwelling. And so when you look at the anatomy of these sub coverages, it looks like this. On the left, you'll see $2 million. We're using that as simply an example of a base limit for a dwelling. And under that $2,000, this is on the left in the green, the $2,000. I'm sorry, the $2 million. Extended replacement cost. You've got code upgrades, debris removal, and landscaping. So those are your sub coverages, and this is how they work. In the middle, where you see base limit for $2 million in blue. Under that, you have extended replacement cost, and we used an example of 50%. Some have 20, some are 25, some are 50, and some are even 100%. And the way that operates and the way that responds is, if your losses are measured over $2 million, then a door opens up, if you would imagine, to this additional coverage. It's called the extended replacement cost. Should it be needed, it's there. Otherwise, if your loss is measured in an example for $1.8 million, you do not get to tap into the extended replacement cost. That only comes into play and gets triggered if the measurement of the loss comes above $2 million. And so in this example, we're going to take 50% of the 2 million, of course, is $1 million. And that's additional coverage, right? It's stackable. Now, under that, you've got code upgrades, otherwise known as ordinance or law coverage. In the policy, you may see it listed as codes. Most of them say ordinance and law coverage. What that does is it covers the amount of extra money it's going to cost to bring your house up to code. Today's standards: fire rated decking materials, fire rated roof, certain R rating window, double pane windows, insulation, etc., electrical, Title 24. The policy responds in such a way that they owe you for what you had at the time of the loss, plus the additional money it will cost to bring it up to today's code. And the code gets triggered in two ways. Number one, you have to have it mandated by the building inspector. That's the first step. It has to be mandated. Secondly, you have to spend the money to get it. Those are the two triggers for you to collect code upgrade money. Now, some policies, most policies pay 10%. Some policies pay up to 100%. While we're on the policy real quick, before I forget, I think it's critical that you all order a certified copy of the policy. We spoke to somebody today in the Palisades, and it behooves me that they didn't even have a copy of their policy and had no idea of coverage. It was an inbound call. And it's rather disturbing if you think about it, because we're dealing in millions of dollars of damage to a property, and yet the insured, the homeowner, did not have a copy of their policy, nor did they, they didn't order it, they didn't have it, they have no idea what the coverages are, and that's quite odd. So you want to get and order a certified copy of the policy from your adjuster, and usually takes a few weeks for it to come in. And that will be, the certified copy will show the latest forms and endorsement changes or any language change that happened over the course of that 12-month period. Your policies go 1 year to the next, and sometimes 2, 3, 6 months in, you'll get that one page mailed to you from the insurance company or emailed, and it'll say California endorsement change. And that's the insurance carrier changing the language, changing the endorsements. And if you don't have that updated certified copy, you may be working with an old policy language that may not apply. And so it's very, very important to have a certified copy for that reason. Also, when you are talking to an adjuster and the adjuster is citing certain parts of the policy under these buckets of coverage, then if you don't have a copy to reference, you're going to be at a disadvantage. Remember, folks, they wrote the policy. You did not. They wrote this contract. Your job now is to help understand how it works and how it responds, so that you're able to maximize your recovery and truly get what you're entitled to. Back to the code upgrades. That's how that works. They pay the differential. So, and I'm going to use an example. If you had a single pane window, for example, in the house that's perished, and that window, to bring it back, is $500 because they owe you for what you had at the time of the loss. But now you have to bring it up to code, and the new window costs $800. $300, the differential, comes out of that code upgrade money. In this example, we have 10%, which represents $200,000 of the $2 million. So you've got $200,000 worth of code to draw from. So in my window example, that differential of $300 would come out of that $200,000. That's how it works. And again, triggers, two triggers. It has to be mandated, and you have to spend it to get it. The next bucket is debris removal, which is a very hot topic in these firestorms, always is, because it's kind of the first phase of the cleanup, obviously, that happens. And we're going to be talking about the nuances of debris removal. But most policies, if not all, have 5% available from the base limit for debris removal. Now, debris removal is calculated into the 2 million. I'm going to get into it just a little bit now. Debris removal is considered part of the 2 million until the 2 million gets breached, meaning the damages have exceeded $2 million. So two things happen. The extended replacement cost endorsement kicks in. You've opened that door, and now the debris removal bucket kicks in as well. So it has to be triggered. Again, if the loss falls under $2 million, including debris removal, it keeps that debris removal door closed. So again, you have to, that loss has to exceed $2 million. And so debris removal there, in this case, you have $100,000 of additional coverage. And under that, we have landscaping. Landscaping is trees, bushes, and shrubs. The policies give you 5% of the 2 million. That's where we got the 100,000. Simple math. Now, the limit is 100,000 in this example, but there's some caveats. Some policies will pay $550 and up to $750 per tree, per bush, per shrub. You may have a 100-year-old oak on your property, which is priceless, really. But the most you'll collect if the policy affords $750 per tree, per bush, per shrub, unfortunately, that's all you have, up to the limit of $100,000. So landscaping is, again, additional coverage. So you got to count the trees, the bushes, the shrubs you had to make claim. We call this the low-hanging fruit. If the property's been completely destroyed, then you should be able to max out that number if you had some beautiful landscaping, some expensive things on the property for landscaping. There's also another coverage called additional increase due to declared catastrophe. Some policies have this endorsement that kicks up in a declared disaster, which this is, kicks up the coverage either 50 or up to 100%. So your 2 million base limit would now, if it was 100% kicker up there, then you would go to $4 million as a limit. So this is why it's really critical to understand how the policy responds and what is truly in those benefits and how they how to maximize it and how to trigger these coverages so that you're able to recover what you're owed. So when we add it all up, you went from $2 million to 3.4 million. So we found $1.4 million additionally. And a lot of this lingo and language, if you would, is hidden in the body of the policy. So if you have the policy, which should be anywhere between 40 to 100 pages long, you're going to find these categories listed in bold in the parts of the conditions, definitions, forms, and endorsements. So under coverage A, this is what it looks like when you break it down forensically, so to speak. Also, before I forget, you can stay on this slide, coverage A. We're gonna get into something else real quick. Before I forget, for those of you that have a mortgage, it is critically important for you to contact the loss draft department at your mortgage company. LOS, S as in Sam, loss draft department. This is a little department in every mortgage company, and their function is to take in checks from settlements of fires, floods, earthquakes, whatever the covered loss peril is, and to process those settlement checks and get them back out to you so that you can make repairs, rebuild, buy, pay down the note, whatever you have to do. Let's talk about this a little more. When you contact the loss draft department, notify them that the house has perished or the house has been damaged and there's an impending settlement check coming, and ask them a couple of questions. The first question is, what is your protocol to release the money back to me once that check clears? So let's trace the check. You have a settlement check, the check comes in, it gets cut from the carrier, it goes to you, your name's on it, or the LLC or the trust, however it's listed on your policy. And if you have a mortgage, make sure that the correct mortgage company is listed on your policy when you get that certified copy, because oftentimes the mortgage companies will sell your paper, your note to another company, and you'll have the old mortgage company listed on the check. The check is useless. It's going to take another 30 to 45 days to get the check canceled, processed, recut, reestablish the new name. So this is really important, folks. It'll save you a lot of time. You want to be as efficient as possible. So again, call Lost Draft, notify them of the loss of the house, that there'll be a pending settlement check coming, and ask them what is the protocol, again, to release the monies back to you. Now, remember, the mortgage company is your partner. They lent you money to buy this property. So they have what's called an insurable interest up to the outstanding note. So for example, if you got $1 million settlement, but you only owe the bank $600,000, then the difference, once that check clears at Lost Draft, they should cut you the $400,000 differential. I'm going to repeat that. If you have $1 million settlement check, it goes to you, you sign it, then you send it off to the Lost Draft department. They're going to put it and deposit it into a escrow account. Whether it's bearing or a non-bearing, I don't know. Everybody has different protocols. Ask them how fast will they release the unencumbered amount. In this example, it's $400 difference. $1 million check settlement, $600,000 you still owe them. They're going to control the $600,000. Now, what does that mean? They're going to control it. Well, they have the right to hold on to it until you provide them with a few documents. And this is what you have to ask them. Another question. What do you need for documentation so that you can start to release those monies, those encumbered amounts to me? Now, they usually release it in thirds, okay? And again, whether it's Wells Fargo, Mr. Cooper, B of A, Nationwide, whoever your lender is, they all have different protocols. So it's really important that you proactively pursue this information, set up your file at Lost Draft. That way, when the check comes, you're proactive, the file's all set up, check goes into escrow, check clears, they cut you the difference, you start the job and you start the repair. And this is very, very important. You could save some years off your life if you notify the Lost Draft department and find out how they release money. Is the check going to bear interest? You could have a $2, $3, $4, $5 million check in there, and if they're holding on to it, making money off it, well, why can't you? So is it a bearing account? Is it a non-bearing account? And how fast can I get that difference that I don't owe you? So it's an unencumbered amount. That's really important. Okay, next slide. Okay, so there's three options you have when you have a fire where it's a total loss. And these are the three options. One, you don't rebuild. Secondly, in the middle, purchase a replacement home, something that's already built in another town, another state. These benefits, folks, will follow you anywhere in the country, just so you know. You're not bound to spend that money or build right there on that street, in this state. The benefits follow you. Or thirdly, you can rebuild on site. So let's go down each one and see how the policies respond. So if you choose not to rebuild, which is a choice, and you have a mortgage, of course, you'll have to pay the note off. Take the balance and go rent or try to buy something else. You can combine your personal property money with the other structure money. Look at that. All the money that comes in, you can look at it globally. So if you don't rebuild, we're going to use that $2 million base limit example again. So you have $2 million. They cut you a check. If that's your damages, you're entitled to debris removal. Remember, if the damages are proven to be greater than $2 million. And then you get that landscaping money up to $100,000 should you have losses that are at that level. Now, what you give up is the extended replacement cost endorsement, that kicker, that money, that extra money, should the loss be measured over $2 million. And because you have to spend it to get it, you have to perform to get that extended replacement cost. Now, I will say there's only, I think, one or two companies out there that are paying the extended replacement cost endorsement without performing. And that's pretty great for them to do that. It's very rare. I suspect it's a management decision at the carrier. It's a great PR move for them. And it's very, very rare. Most, probably 99% of the companies out there require you to perform in an effort to collect the extended replacement cost if you purchase a replacement or rebuild on site. But if you don't rebuild, you're giving it up. Additional increase due to declared catastrophe, that as well is left behind, as well as the code. Remember what I said about code, folks? It's triggered by having the building department mandate. That's number one. And number two, you have to spend it to get it. Okay, so that's what happens under the no rebuild option. And I've had a lot of clients over the years basically pick up and say, I am not going to spend millions of dollars in rebuilding an ashtray. There's no trees, everything's changed, and I am not going to invest that money because it's going to take 8 to 10 years for all the trees to come back, and it's all going to be different. So again, it's an option. You can do that. In the middle, purchase a replacement home, same thing. You get base limit, $2 million. Debris removal, yes. Landscaping, you're entitled to that. You are entitled to the extended replacement cost endorsement, by the way. So if you choose, for those of you that don't have the wherewithal to wait 2, 3, 4 years, go through the heartache of finding a contractor that's reputable and redesigning the whole thing, we find that some people just don't want to deal with that, and they would rather move their family back into a home that's existing, a beautiful home, and put it all behind you and move on. You can sell the land, hold on to the land, pay off the note, and move on. You are entitled to the extended replacement cost. The question mark under the increase due to declared catastrophe, if you have it, we would have to read the policy. You would have to see if, in fact, that is transferable and available without performing. You are entitled to code as well. If you purchase a replacement property, maybe the property you purchase is not up to code like your home was, and it would cost extra money to bring it up to code. So that should be transferable as well if you purchase a already built replacement property. Thirdly and lastly, if you rebuild on site, you're entitled to everything. Again, no different than the purchase or replacement property. And again, you'd have to see the declared catastrophe endorsement. If you have it, that's great. You're entitled to it. And read the policy. It's all going to be in there. It's a contract. And that information is readily available for you to go through. So these are the 3 options you have under the dwelling coverage. Next. Okay, coverage B. They're usually 10% of the base limit, so that's how we got the 200,000. So garages, workshops, detached fencing, retaining walls, etc., pools, cabanas, walkways, driveways, patios, sprinklers, all the stuff that's detached from your main dwelling is considered other structures or pertinent structures. In this example, we have the base limit of 200,000, which is 10% of the 2 million. You may have extended replacement cost endorsement, so you want to look for that. That'll kick that number up should the loss be measured for greater than 200,000. That's why we left it blank. We don't know if you have it or not. It's only in a few select policies. You are entitled to debris removal. Again, the debris field is not just the main dwelling. It's the rest of it. The other structures, the personal property, etc. So debris removal is there. And code upgrade, if you rebuild your shed, pool, your whatever it is, your garage and workshops, they have to be brought up to code. Title 24, the electricity, the energy efficiency, fire rated materials, all that's part of the code upgrade package. And in this case, you have $20,000. So we found 230,000. The debris removal is really going to go to the debris removal people. So in this example, really, if you peel away the $10,000 for debris removal, because you're going to spend that to get rid of the stuff. So you got $220,000. This is a pretty simple bucket of coverage. Next. Okay, personal property. This is a tough one, folks. Personal property is just that. It's personal. And it is probably the most arduous, the most daunting task you'll probably ever go through. It's emotional. It's everything. It'll take years off your life if it's not handled properly. And I'll tell you why. Beyond it being personal. So in this example, we have $1.5 million as a base limit. Under that, you have sublimits of coverage and then scheduled items. Let's go through it. So if we took the house and shook it up, peeled the roof off and shook it, tip it upside down, and whatever falls out of the garage, the loose furniture outside, like your patio furniture, all that stuff is considered personal property. Now, under that, sublimits, that BPP means business personal property. The insurance companies have limitations on business personal property that's in the house. So for those of you that have a home office and a separate room dedicated to the home office, for example, and you've got a desk and you've got computers and printers and fax machines, and if you had a fax machine, then that's all would be considered business personal property. Now, most of us use the computer for maybe 80% business, the rest of it for personal use. You can separate that. But remember that you're going to have a sublimit for business personal property. Some policies have $5,000, some have $10,000, some have only $1,500. So you got to look at that and separate it on the list because they're going to bring that up. They want to make sure that that they're not paying business personal property under the personal property bucket of coverage. And look, they want you to take out more insurance, right? If you're running a business, you should get a business owner's policy. So that's why they limit it. Watercraft are limited as well, cash, etc. You'll see it under special coverages or special limits of personal property. It's in bold under the policy. You'll find it. It's about in the middle of the multiple pages of the contract. And under that, you get scheduled items. Scheduled items are, we see a lot like jewelry. Usually people have very expensive jewelry. They'll take out a separate rider, if you would, called scheduled items. And, the item gets appraised and there's an agreement between the insurance carrier and you that ring was $50,000 and should it get damaged or destroyed, then they pay it. That's the appraised value. Everybody's good with it. And that's a scheduled item. And so jewelry, furs, things like collectibles, artwork sometimes could be scheduled. It depends on what you have. So don't forget about those items as well. You may have bought in the rider years ago and you just don't remember. So you look for those items, these different coverages under the personal property bucket of coverage. In red, you see no, go back, please. Thank you. In red, you see ACV versus RCV. These acronyms are ACV equals actual cash value. That's what that means. RCV means replacement cost value. And then we see depreciation. We're going to talk about this a little bit in depth because it's very confusing. The depreciation is going to be taken on the dwelling, coverage A, coverage B, other structures, and personal property. The way it works is that you have to get the insurance company on the hook or to agree of the actual replacement cost value of the item, the house, the other structures, whatever it is that you're claiming. What is the replacement cost value? No deals, no discounts, including tax, delivery, setup, and warranties. Some people bought warranties on their furniture. Now it's gone. And so that's part of the replacement cost value. It's the all-in number. Once you have that all-in number, it is subject to depreciation for wear and tear, age, condition, obsolescence, things of that nature. And that's going to drive the replacement cost number down to what we call actual cash value or fair market value. The insurance company only owes you the used value until such time as you replace the item. Let's put some numbers to that. So let's say you have a couch that you bought for $5,000 8 years ago. But due to the increase in the cost of living, that $5,000 couch that you bought, or $6,000, whatever that number was, is now $10,000 to buy. And that includes the tax, the delivery, the setup. So the insurance company says, okay, we agree to buy and replace what you lost. That couch is $10,000. But we're going to depreciate it for wear and tear, age, condition, obsolescence, et cetera. And now that's a very negotiable number. It's very subjective. It's not only based on the age of the item, but in California, it's the condition of the item. Now, you could have a formal living room that was barely ever used, and the item could be 10 years old, 15 years old, but it's in excellent condition. They shouldn't take that much depreciation on it. Remember, because the condition of it, and no one knows the condition better than you. You live there. The adjuster doesn't know. If we're representing a case, we don't know. So you have to be honest, fair, and reasonable. So if the couch was in excellent condition, then it's listed as excellent. Very little depreciation can be taken off of that $10,000. It could be in fair condition. It could be in poor condition. It could be in excellent condition. So the point I'm trying to make is that the condition of the item is also taken into account and not the age. It does not matter what you paid for it. It does not matter if Uncle Melvin gave you the couch years ago. It does not matter that you may have had a parent that passed or a relative and you've now inherited all their stuff and it's stored in your garage. It does not matter, folks. It's what it costs today to replace, period. Now, I'm hearing some stories where adjusters are asking for like, what did you pay for it years ago? Folks, that's not a condition of payment, okay? You don't need receipts. You don't need receipts. It's not a condition of payment. You have to be fair and reasonable and accurate and defendable and be honest and truthful. That's the bottom line. So replacement cost, again, the couch, $10,000. Let's say the depreciation on this thing is $2,000. You're going to get a check on that couch for $8,000. That's the actual cash value, the used value of that couch. What happens to the other $2,000? Well, the insurance company gets to hold on to it until such time as you spend $10,000, which they agreed to pay. When you hand in the receipt for $10,000 or more, they're going to give you that $2,000 depreciation back. That's called depreciation holdback. That happens with the dwelling, other structures, and the personal property. Now, here's where you're going to lose years off your life with personal property. And don't shoot the messenger. I'm just being straightforward with you here. If you can imagine having to list all these line items, and most houses could have 2,000 to 4,000 line items. If you have a large house, it could be more if you've been there for years. And you go through and you're putting replacement costs, and then you figure out the negotiable depreciation on it. Everything, by the way, everything's negotiable with an insurance company. Everything, okay? Don't let the insurance company tell you otherwise. It's all what you can negotiate. So the thing about it is you don't want to get into this cat and mouse game where you have to hand in a receipt for everything you buy. The way to skirt this years off your life deal and cat and mouse game with a cubicle farm employee scrutinizing every purchase you make, quite simply, is to inventory everything. I mean the toothpicks to the toothbrushes, silverware, everything, all the items. You make a list, and the goal here is to exceed the 1.5 million. So we're going to use that example, that 1.5 million you see on the screen. That's the personal property limit. Let's say you do a proper inventory and you do the research and it comes up to 2.5 million. That's the measurement of your personal property, but you only have 1.5. And let's say they depreciate $500,000 off that 2.5 replacement cost. Now you're at 2 million depreciated value. Well, the 2 million depreciated value is over the 1.5 million. You now got your 1.5 million without having to hand in receipts. That's the goal. The goal is to exceed the base limit legitimately far enough so that even after they apply depreciation, that limit gets breached and you get all your money. That's how you do it. That's the goal. That's the goal to maximizing your recovery. If the inventory falls short of 1.5 and the depreciation comes into play, if you want that money, you're going to have to do the work. You're going to have to deal with, some cubicle farm at the carrier's corporate office, handing in receipts for the next few years of your life. And I got to tell you, folks, we get calls all the time, these inbound calls, especially on personal property. They throw in the towel. Look, the insurance company's smart. They've done the math. They know you're not going to replace every item you lost in your house, and that's fair to say. They know this. So they like to sometimes play a heavy hand in depreciating all the items, knowing that you're not going to replace it all. It becomes a windfall for them, and they get to keep that difference. It's a great game. They figured it out, but it's a great business model for them. So this is why we're sharing the information with you, so that you can help yourself through this process and understand how to navigate these complex issues. Next slide. These are the common questions. Do I need to list every item? Well, Ricardo Lara, the insurance commissioner, has recently, because of all these firestorms that have been going on over the years, he is trying to simplify the process. Still complicated though, but where you're now allowed to categorize your personal property items. So furniture, bulk X number, clothing X, CDs, albums, etc. And so I don't know how many categories they have come up with. Could be 70 to 90, could be 100 categories. And so if you list the items, the devil's in the details. And the more detail you provide, the less the insurance company can argue. It's when you leave things vague that they can come back and argue. Remember, there's no law that says they have to be accurate on their offer of settlement, folks. None that I know of. I'm licensed in over 20 states. There's nothing that I've seen that says they have to be accurate. You're the claimant, not them. So if you want all the money, and this is assuming you got a good policy and not that you're not grossly underinsured, they want you to do the work. So do I need to list every item? To that I say, do you want all the money? Number two, what is the holdback and how does it work? We kind of just talked about that. So again, replacement cost minus depreciation equals actual cash value. When you spend the money and you replace that item and you show them and prove it to them, they'll give you the depreciation money back. Again, that's true on the building, the dwelling and other structures, and that's true on personal property. The way you get, number three, how do I get my withheld depreciation? Well, you got to, again, hand in receipts, prove that you spent the money. If you want the money, you got to do the work. Next slide. These are some tips and tools and things that, will help you. Keep a pad and pen with you at all times. You could be driving. You might want to talk into the phone, the voice memo on your smartphone. Keep it on your bedside. I was a fire victim 33 years ago. That's how I got into this business. And I remember what it was like. And, you could be driving along or you wake up in the middle of the night thinking about, oh, did I list that item? Oh, I had that in the garage. I forgot about that. Every item counts because it all adds up, folks. And keeping a pad and pen with you all the time. Don't rely on your memory. You're in the spin cycle right now. And you cannot rely on your memory to serve you in a time of a firestorm. You've been displaced. You're looking for housing. The kids got to get to school. You got to go to work. So this will help you jot down your items that you can think of when you're thinking of them. Draw out each room one by one. Kind of in your mind's eye, go through the house and draw out the layout. Walk in, visualize it. You walk in the front door. What's to the left? Look up. What was there? Oh, a coat rack was there. I remember that. Oh, and I had a shoe holder down below in the mudroom. Things like that. Then look to the right. Look up top. I had some stuff hanging there. This is how you do it. You visualize it in your mind's eye. Don't forget the junk drawers. People laugh when I say that, but the reality is I've got 2 junk drawers. There's probably $700-800 worth of stuff in there. And, we tend to devalue what we own when it comes to personal property claims. And don't do that. Remember, it's what it costs today to replace. No deals, no discounts. Don't forget what was under the bed, the dressers, all the stuff we stuff and hide, out of sight, out of mind, out of sight, out of mind. Use family and friends. Let them help you research, price items. After these events, I'm sure you all got called by relatives, friends. Oh my goodness, how can we help? We're here for you. Put them to work. Put them to work by pricing items. You can certainly do that. If they have photos, ask them, when you were at my house last holiday, do you remember those pictures? What was in the background? This is how we recreate items and jog memories for your personal property claim. Photographs, documentation, cloud storage, all that stuff is it will help. It's evidence to help build your case and build and defend your claim. Remember, the more details you have, the stronger the case. Next slide. Lastly, the fourth bucket of coverage is loss of use. Now that you've lost use of your home and you're displaced, you've got benefits there. Now, this is a use it or lose it bucket, folks. Let me get some water here. This is a use it or lose it bucket. There's two separate types of coverages. There's ALE, additional living expense, and fair rental value. Look at the policy. You'll see it there. It'll say one or the other. And they're a little different in how they respond. Under ALE, they both provide the money for your temporary housing. And what it says in there, that your standard, quote, your standard of living is to remain the same, and for the shortest period of restoration. I'm going to repeat that. Your standard of living is to remain the same, no more, no less, for the shortest period of restoration. We're going to do the ALE first and then move over to fair rental value. Again, temporary housing, use it or lose it. Furniture rental. You're not going to go out and buy a ton of furniture because you may move into a house already built. You don't know what the layout's like. You don't know what the colors are. So you want to use that benefit and rent, lease furniture. Of course, you're going to buy a mattress and box spring. You're not going to lease that, certainly, but you do want to use that benefit to rent furniture for the duration of the claim, as long as you don't run out of that money. If there's obviously there's going to be a budget there, so make sure you budget correctly. Increased mileage is covered to and from. If you're now living 20 miles, 30 miles, whatever it is, away from the lost site where the house was, and you're incurring all this extra mileage, whether it's dropping the kids off to school, you're living far away, further away, and your increased mileage is covered. So there's an app I would recommend called Mile IQ. I think it's about $5 to get, and it tracks your comings and goings. It's great. And you swipe one way if it's fire-related mileage, and you swipe the other way if it's personal, going shopping or whatever. So very important. I got to tell you, it'll add up to quite a few $1,000s at the end of the claim. If you think about it, 2 years, 3 years, you're running around trying to rebuild. You got all these site visits. You're incurring all this wear and tear on your car. It's covered under ALE. RV and boat storage is covered as well. Animal boarding, dogs, cats, right after an event. Some hotels, some Airbnbs may not allow pets. So if they needed to be boarded, those are covered. I don't know that they'd cover fish, turtles, or horses. That might be a different type of policy. There's a dollar limit and a time limit. Let's talk about that. You want to look at the ALE coverage as a dollar, as a budgetary number. So for example, if you have $300,000, I'm just using a hypothetical number. If you have $300,000 in that account and you calculate it's going to be about probably 36 months that you're going to be out, do the math, divide it. That's your monthly budget, including the rental and the furniture rental. And remember, the mortgage company still wants their money every month. So if you run out of ALE money and the insurance company is off the hook, they've exhausted that bucket of coverage is done, you're going to be in trouble, because now you're paying rent, and it's not cheap, and you've got to pay the mortgage. So you don't want to be upside down there. So remember, look at that critically, budget properly so that you can make it last as long as possible, just in case. That's additional living expense. Fair rental value is a little different. It's what your home would have rented for prior to the fire. So a lot of folks that have California Fair Plan have fair rental value. So how does that work? Basically, you get comps in the area of what your house would have rented for prior to the fire. That's a number. and you take that and times X up to the limit of coverage. Most people will go through that rather quickly. These firestorms, no matter what the cities and towns and the government tells you, you better prepare for the long haul. It is a process, folks. Again, don't shoot the messenger. I've seen tens of thousands of these houses and businesses get destroyed. It is a long, arduous process, and understand that budgeting, your loss of use bucket of coverage is really important. For those of you that have low budgets under loss of use, it's going to be tough. So prepare for that. The carrier owes increased cost due to limited housing. As you can imagine, the rental market gets flooded with, I think this event had 16,000. I think up in Paradise when we did that, there was I think close to 25,000 homes perished and businesses. And you want to talk about a run on housing, that was amazing. And so, landlords start increasing, jacking up those rents. The insurance company owes for it. Okay, it's got to be fair and reasonable. That's what they owe for. Next. How do I ensure I do not leave money on the table? These are what we usually hear. You have these questions. Look, don't talk to the insurance company about your end game. And I'll tell you why. Because you're telegraphing your position. This is a game of strategy. The adjusters are doing their job. They're adjusting numbers. That's why they're called adjusters. Don't mistake friendliness for a friend. The adjuster could be as nice as pie, he or she, but they've got one master that they owe answers to, and that's the insurance company. And they can't represent two parties at the same time. So if you need to strategize, feel free to call us. We can talk about it. Call an attorney. Anybody that's licensed to do this. But if you show your cards, you may damage your claim. That's important to understand. Don't step on the landmines. Understand that what you say may impact your recovery. Know your policy. This is why we're doing these webinars, to give back to the community and teach you to help yourself through the process. Meet with a claims consultant to explore your options, an attorney or a public adjuster, which are the only two disciplines licensed in the state to represent the public in these matters. Not contractors, not remediation people, not ServPro, they can't act as a public adjuster. Someone ultimately familiar with negotiating claims. This is what we do every day. Our phones are open to you guys. If you have questions, doesn't mean you have to hire us. There's no cost. There's no obligation to hire us, but you can get some answers to hard questions you just can't ask the adjuster. Feel free to call in. We take inbound calls all day, and we help people understand how their unique situations, how to navigate through them, and how the policy will respond. Do I rebuild? Well, it depends on your overall goal, and how will your policy will respond to that goal is important to understand. So, do you have a mortgage? If so, what's the balance? It may play a role. Remember, if you clear and sell the lot has value. In some communities, the dirt is worth more than the house itself, the building. And we see that quite a bit. What are your restrictions, if any? The code claim. Does it transfer if you don't rebuild? It does not. You have to rebuild. You have to spend it to get it, or you have to purchase a replacement property that's built, and you can transfer code money. Is that important, and how might it affect your recovery? Those are things to consider. Should you buy instead? Again, we talked about that. If I buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? Again, these are all things that need to be considered in an effort to maximize the recovery. It's a process of thought. It's a process of strategy, and understanding how to maneuver through that contract is the key to successful resolution. We have taken some snapshots here of the recent insurance code changes that our insurance commissioner, Ricardo Lara, has done over the years. These have changed, and they keep getting, better for the consumer. rightfully so. And so I would take a screenshot of these next few slides we're going to show you, which are snippets of the language changes and the reference to the code section in the California Insurance Code. So again, take a snapshot of that, screenshot. Next slide. Here's another one for you. I'm going to give it a moment. Next. Next slide. Oh, I think we're jammed up here. Okay, one more slide. Okay, I think we're having a technical issue here. Yeah, I guess it's frozen. Let's go over this slide while we're on it. My technician is trying to figure it out. Okay, so this covers additional living expenses. It covers the advance payments. By the way, a lot of you have gotten advance payments. Keep in mind that those are simply undisputed amounts of money that are available but they don't construe a final settlement. Very important to realize that. They're just large advances against damages. Now, some carriers are paying 75% on contents. And, you know, that's a nice gesture, but if you want the other 25%, you're going to have to do the work. Some are giving 100% of the building, the base limit for the building. Well, that's, again, a nice gesture, but if you want the extended replacement cost money, the extra money, that it has to be triggered. Okay, very important. Okay, we got a note from my tech. It says lost power. Back up now. Next slide, please, if we've got it. And still having a problem. Let's see. Sorry, folks. Okay. Technology is great when it works. Well, we'll keep talking until this slide moves on to the next slide. We've done 5 of these webinars. This is the first one we're having an issue with. Okay, so again, oh, we got it. All right, we're back up. So let's jump in. So take a screenshot of this here slide. By the way, while I'm on this slide, I want to mention something. We get calls all the time. People saying, I have called my adjuster and emailed him 5 times this week, 3 times yesterday. He or she is not getting back to me. Well, the insurance adjusters have 15 days to respond to your inquiry. Now, some are mindful and stay within the boundaries of that 15 days, some adjusters, and others don't. Okay. So, but just know that they do have 15 days to respond. And you can imagine how inundated they are. So if they are definitely getting back to you within 15 days, that consider yourself blessed. Okay, I believe that's the last slide for the insurance codes. And next slide. And I think we might have lost power again. Okay. Let's talk about debris removal. Well, he is trying to fix that. Let me just check something real quick. Okay. Okay, let's talk about debris removal. So the debris removal program comes around at every firestorm. And the way that works is you can either opt in to the Army Corps of Engineers or not. Now, for those of you, let's talk about the opt-in, then we'll go to the not. For those of you that opt in, the Army Corps of Engineers will come out in 2 phases. Number 1, you have to sign a right of entry form, and they will come out and take the propane tanks, the gasoline tanks, the paint cans, things, the loose hazmat that's on the lot. That's phase 1. And then phase 2, they'll come out with the backhoe and with the grapple truck and the dump trucks, and they'll just clear out all the debris. They're going to dig down 6, maybe a foot. And what's left at the end of it is a hole where your house used to be. Now, I would implore you to be there when they are doing that job, kind of like bulls in a china closet. They don't have to be perfectly accurate. They're working as hard as they can to clear those lots. However, you want to be there. I'll tell you why. Number one, it's your lot, your land, your pool, your walkway and driveway. If in fact the driveways and walkways are salvageable and they're not spalled, spalling is when the heat, the intense heat wicks out the moisture out of the concrete and renders it brittle. And it no longer has the tensile strength it had to hold up structures, cars, whatever. And so if the driveways and walkways are salvageable, then you may want to consider putting sheets of plywood down to salvage them, because those have value. Those have value. If you're going to sell a lot, for example, and the driveway and walkways are already, they're there and they're salvageable and they're good, that potential buyer now doesn't have to incur that expense. So it adds value to the claim. I'm sorry, the piece of property in the sale situation. So again, if you opt in, Army Corps comes out, they're going to schedule it, be there, make sure you're there to, make sure they're doing a good job and they're not damaging things that they shouldn't be. There's some chatter about leaving retaining walls in for those of you on the hillside, so to prevent mudslides. So look into that. And the way the billing works is if a lot, I'm going to just use a hypothetical, if you have $100,000 in your debris removal bucket available, then and then the bill comes in, the Army Corps of Engineers has done their jobs, and the bill comes in 8, 9, 10 months later, or a year later, and the bill is $175,000, and you only had $100,000 worth of limit in the debris removal bucket, the difference will be subsidized. Okay, so that's a plus, and a lot of people opt in, and it's a good program for those that are short on debris removal. That way, the money doesn't, you're not taking money out of your rebuild money. It's separate. Now, the insurance companies might pay you directly for the debris removal, and so make sure you earmark that money, put it aside, because that bill is going to come in eventually, and they're going to want the policy information and such. So. So the opt-in is good for those that have low amounts of money in debris removal bucket, or for those that don't have any insurance. So that's a good thing. If you have a lot of money in the debris removal, you may have $200,000, $300,000, $400,000 in that debris removal bucket. Remember, it's based on a percentage of that base limit. Then you might want to consider having a private contractor. He's got to be hazmat licensed. Do it. You have more control, probably do it faster. The end game here, folks, is for you to walk away with a certificate of clearance. That is the most important piece of paper you're going to get. That certificate of clearance from the city will deem that lot clear of hazmat and it's ready to be built on. Again, so if you are trying to sell a lot and you don't have a certificate of clearance, it's going to be very difficult to sell that lot. So it's important that you get that. And there's a process. So again, if you have a lot of money in the debris removal bucket of coverage, you may want to consider a private contractor. Again, as long as they're licensed, hazmat licensed. You need a license because everything's hazmat. Okay, that's the debris removal program, kind of in a nutshell. Next slide. Next slide. Okay, we don't have one. All right, I'm going to do some Q&A. We're going to open it up for Q&A. So here's one. If my home's air quality remains unsafe after the insurance approved the cleaning, can I demand additional remediation or refuse to return home? That's a great question. Well, first of all, how do you deem the air quality unsafe? That's the first question I would have. Is there an environmental hygienist that's come out and has tested it after the cleaning? If the results are you still have heavy metals, lead, asbestos, whatever it is, carcinogens at a level deemed unsafe, then you might have a good argument there. Can you demand additional remediation or refuse to return home. Well, look, that's a healthcare issue. There's nothing more important than our health, folks. And so I would say, if you have the argument that it is still unsafe after the cleaning, that's going to be an argument to have with the insurance carrier. Okay. The next question is, how do insurers differentiate between cleanable damage and irreparable damage? Well, it's either going to respond to a cleaning or not. The key word here is you're entitled to pre-loss condition. Those are the key words, pre-loss condition. And if it's irreparable in this example, means it's a total loss, or you may have curtains that go out for a cleaning if you have a smoke loss, and they come back and they're 3 inches shorter. Well, that's not pre-loss condition. That's a total loss. So that's the difference. It's either salvageable or non-salvageable. If they go out for cleaning and come back still smelling like smoke, or they've shrunk, then that's not pre-loss condition. You're entitled to get it replaced, paid to replace. What are the industry standards of making this determination? It's all negotiable. I mean, look, if your mattresses, for example, if you're a smoke loss, you can't clean the inside of the mattress, the cushions on the couch, on the kitchen chairs. How do you clean the inside of the foam? When you sit down, you can clean the exterior, HEPA vac it and do all this stuff and try to deodorize it. But when you sit on it, it's going to displace air through the foam cushion, and it's going to smell like smoke. So these are the issues. So it's really a case-by-case basis. There's not one standard. I'm always going to refer back to pre-loss condition. Hi, Jeanette. Hi there. Thanks for the question. Hi, my policy has paid out. They do not have a separate amount for debris removal. I've heard estimates ranging from 170,000. Yep. 36K is it wise to inform my insurance I will opt out and pay the 36K privately? I'm a little confused there, Jeanette, if you can clarify. I'm a little confused as to they do not have a separate amount for debris removal. There has to be a separate amount. It's built into the base limit, Jeanette, until the base limit is breached. Then it becomes additional. So I think if I'm reading this correctly, if you only have $36,000 available in debris removal, and you get an estimate, and it could be $100,000, I would opt in. I would opt into the Army Corps of Engineers, because after the 36,000, whatever it costs extra, it's going to be supplemented by the government. So I don't think that doing it privately with $36,000 is going to cut it, unless you got a really tiny lot and maybe a 900 or 1,000 square foot house. But if you've got a regular size house, 1,500 to 2,500 square feet or bigger, I can assure you the debris removal is going to be a lot more than $36,000. So I would opt in. That's my recommendation. But you got to, find out. I would more or less want to find out why they don't have a separate amount for debris removal. That's rather odd. I've never seen that, unless it's fair plan and you just don't have it in the language. Otherwise, if it is California fair plan, Jeanette, then it's built into whatever that base limit you have, and it's going to come out of your rebuild money. Another question. I hope I answered that. If I stay in my second home instead of renting elsewhere, can I still receive imputed rental compensation under my ALE coverage? You can, but you have to be transparent about it, because you cannot profit from a loss. So if you tell the adjuster, hey, and by the way, I'll just use an example. We had this happen in Santa Rosa, where there were some well-to-do folks that owned rental property in Santa Rosa, in town next door, and they lost their house in the firestorm, the Tubbs fire, 2018 or 2017. And what happened was they got their tenants to vacate, and they moved into the property, in their own property, and the insurance company agreed to pay. So it is negotiable. You can't profit from a loss. Typically, again, you have to be transparent, truthful, honest, and hope that things swing your way. what I've seen is if the insurance company is paying an LLC, for example, Joe Smith has the fire, house burns down. Joe Smith owns rental property of which he's going to move into, but the rental property is under a trust. It could be the Santa Rosa Trust, or in this example, or it could be the Santa Rosa LLC. Well, the insurance company's not paying the LLC and not Joe Smith directly to stay in his own house. So there's workarounds, but again, run that by the insurance adjuster. Be truthful, be honest, tell them what your intent is there on that one, and see how they can work it out for you. Second part of that question is, how does my insurer determine the fair rental value and what factors influence their calculations? Well, it's got to be your same standard of living. Okay, so what does that mean? Well, what you had, all the amenities. If you had a 3-bedroom, 2-bath home with a backyard, that's what you're entitled to. You can use comps in the area, comparables. That's another way to do calculations. If I disagree with their estimate, what can I do to challenge it? You got to remember, you're the claimant. There's going to be disagreements. There's always differences of opinion with the insurance company, always. If they were, just rolling over all the time, they wouldn't be called adjusters. They'd just be called customer service people. So, again, keep in mind, everything's negotiable, and you can submit whatever you want, but you have to defend it. And as long as you're operating within the four corners of that contract, then you're good. Next question is, developers and investors are buying up wildfire damaged properties in my neighborhood. What factors should I consider when deciding whether to rebuild or sell my land? Well, that could be value of the land. You got to look at the math. At the end of the day, when you look at the settlements globally, you take the three buckets: the dwelling, the other structures, the personal property money, all combined, minus the mortgage that you owe, plus the sale of the land. That's the all-in money. That's one factor that will help you determine what makes sense here to either buy, sell, etc. Another one, the insurance company is issuing multiple partial payments. If I accept them, does that limit my ability to negotiate a higher settlement later? No, let me answer that. As long as that advance, or that undisputed amount, we call it, as long as that doesn't say anywhere on the check stub or the email or the electronic transfer, as long as it does not say this construes a final settlement towards dwelling, this construes final settlement. The key word is final settlement. Otherwise, acknowledge you received it and call it an undisputed amount. Second part of that is, are there any legal or strategic risks to cashing these checks? Only if it says, and we've caught a few in the past, people from way on the other side of the country, adjusters, that had put in a final settlement on like a pretty good size advance. That's not okay. Okay, so make sure it does not say final settlement. Next one, Bob Brown. Does the fair plan line up with most of what you've been talking about? Yeah, it does. Fair plan, it has their own unique stuff. What they don't have, fair plan sometimes does not have extended replacement cost endorsements. Fair plan does not have landscaping coverage oftentimes. They have, some of them are pretty bare bones, Bob, that we've seen. But yeah, the A, B, C, and D buckets are listed that way. The fair plan also uses fair rental value as a loss of use type of valuation method. Okay, and so they're pretty, when you look at the declarations page, Bob, you'll see everything checked off of what your coverages are. And so it's pretty clearly spelled out on your declarations page. But yes, everything I've said should line up with fair plan as well. Jeanette again, hi. No, they say it should be included in the base limit payout. Well, look, if you'd like, I'd be happy to review it. Send me the policy, PDF it over to me. My email is on the screen. And I'd be happy to look through and comb through that policy to make sure that the interpretation of that contract from the insurance side is correct. Okay, you just don't know until you know. You got to look at it for yourself. No one cares more than you about your money, your house, your claim. So, and again, we'd be happy to look at it and review that for you. No cost, no obligation. If it's included in the base limit, I'm not sure who you're insured with, but second part, no, I got a private estimate for 36,000. So then okay. Well, look, if regarding your second one with the $36,000, just do the math. If it makes sense, it makes sense. But you want to make sure that whoever gave you the estimate, the private estimate for debris removal for only $36,000, make sure they've got a hazmat license. Make sure they pull the permits, because I got to tell you, the building inspector, the Palisades and Altadena, Malibu, they're trying to kind of steer everybody into the opt-in program so that there's more overall control and they can do it systematically. But if 36,000 is the number and your guy, your private contractor is willing to do it and he's licensed and he can get you that certificate of clearance, then that's great. Nothing wrong with that. Amica. Yeah, I dealt with Amica plenty. They're in the East Coast. Okay. Yes, they are certified and permitted. Great. But my question is, do I need to share the info with Amica? Well, yeah, because ultimately they will either pay him directly or find out from the adjuster, Jeanette, if the adjuster is willing to pay you the limit of $36,000. If that's your limit in the Amica policy for debris removal, then have them cut you the check and then you pay the contractor. You can do that. But usually they do want to see it spent. They do need to see something. You can't just ask for money without some kind of proof that it's been spent in most cases. Bob Brown again, the insurance company, I'm not sure what that means. The insurance company is wrapping us goof up. What? They quoted the insurance company. Okay, I don't understand. There's some typo there. They quoted us and the replacement value was checked. When we got the policy, the replacement value was unchecked. Okay, this sounds like a fair plan issue. I've had quite a few call-ins like that, Bob, where there was an initial policy established with your same exact setup, and then when it renews, they uncheck it. Look, the only way that matters, Bob, is if the limits of the policy are breached, meaning you've collected every dime, regardless of whether it's checked or not, is fine. The only time that comes into play is if you're looking to get back that depreciated amount. Okay, that's when it comes into play. So again, if you're collecting all limits and you're exhausting the limits of those buckets under that policy you got, Bob, then it doesn't matter, because they're done. They've paid out everything. When it would matter, again, I'm going to repeat it, is when your replacement cost less depreciation falls under the limit of insurance, and now you're going back, you want to get back that depreciation. You're not going to be able to if the replacement cost valuation method is not checked off and you're only getting paid actual cash value. I hope that made sense. Jeanette, the limit is 90,000 after I've spent all of the base. Jeanette, why don't we talk tomorrow morning? Give me a call, email me. Let's set up a time to chat. Because I can answer you more precisely if I have that stuff in front of me. At least let me put eyes on it, and I'd be happy to do it. Again, there's no cost, no obligation, but let us help you with that. Be happy to do that. If there's no other questions, I hope I answered everybody's questions, and I hope I've shed some light on how these policies kind of operate. My name and contact is there. Please feel free to reach out, email me. Let's set up a time to chat. Again, we'd be happy to review your policy, your unique situation, answer the hard questions. We are doing these seminars Wednesday evenings at 6:30. I believe we have 3 more to do. This is the 5th installment of 8. And so we will have a couple more and spread the word. Tell your friends, neighbors, people that you may know that could benefit from the information. And again, we're happy to give back to the community who's supported us for so long. And I hope you enjoyed the webinar and got the information that was helpful and needed. I bid you all a good night and good luck with your claims. Thank you for joining us.